Have you ever found yourself, sifting through just mountains of financial data, trying to make sense of complex market movements, and just wishing there was a clearer, maybe more direct path to truly understanding what's actually going on, cutting through all that noise to get to the core insights? Well, that's exactly what we're aiming to do for you today. We're about to plunge into one of the most persistent and honestly intriguing puzzles in finance and accounting. It's widely known as the accrual anomaly. Now, at first glance, the anomaly itself, it sounds deceptively simple. It basically observes that companies reporting a high proportion of accruals, those non-cash accounting adjustments that differentiate reported earnings from actual cash flow, they tend to generate lower future stock returns. And conversely, firms with low accruals seem to consistently yield higher future returns. Sounds like a straightforward predictive pattern, right? But this predictable, persistent observation has, well, for decades, it's really stumped even the brightest minds in finance. The conventional wisdom, the sort of established interpretation for many years, was that this anomaly was pretty compelling evidence of investor irrationality. The thought was that people, in their trading decisions were systematically misinterpreting or maybe overestimating the true economic value of these accounting numbers, and that this led to predictable mispricings in the market. But hold on to that thought, because this is where our deep dive truly begins to challenge that conventional wisdom. Today, we're not just re-examining the accrual anomaly, we're exploring a groundbreaking, almost paradigm-shifting alternative, the optimal investment hypothesis. This is a revolutionary idea suggesting that this anomaly might be entirely rational, rooted deeply in the fundamental economics of how companies actually make their investment decisions. So our mission today is clear. We're going to unpack this fresh perspective, understand its theoretical foundations, and rigorously examine the robust empirical evidence that supports it, all to provide you with a deeper, more nuanced, and perhaps entirely new understanding of why markets behave the way they do.
And we couldn't ask for a better guide on this journey than the seminal paper that really anchors our discussion today. It's titled The Q-Theory Approach to Understanding the Accrual Anomaly, authored by Ginger Wu, Lu Zhang, and Frank Zhang. It was published in the prestigious Journal of Accounting Research. What's fascinating here is the sheer power of this paper. It lies in its fundamental reinterpretation of what accruals truly represent. It moves decisively beyond those long-held assumptions of investor irrationality. Instead, it proposes a truly economics-based framework, one that's deeply rooted in the well-established Q theory of investment. As we navigate this complex landscape, we'll scrutinize their four main lines of empirical evidence. And we'll reveal how this new theoretical lens not only explains the accrual anomaly, but also sheds crucial new light on other existing market puzzles that until now were largely attributed to investor behavioral biases or, mistakes.
Okay, so let's start by laying a really clear foundation. What exactly are accruals? For those of you who regularly delve into financial statements, you'll probably recognize these as the non-cash components of a company's reported earnings. Essentially, they are the accounting adjustments designed to match revenues and expenses to the period they occur, regardless of when the actual cash changes hands. So think of it this way. Accruals represent the difference between a company's reported net income and its operational cash flow, right? To make it more concrete, imagine a company that sells goods on credit. They've made the sale, the revenue is recognized, and their reported earnings get a boost. But the cash from that sale, it might not arrive for 30, maybe even 60 days. That recognized revenue before the cash is actually in the bank, that's an accrual, specifically an increase in accounts receivable, or considered depreciation. The expense of a factory slowly losing value is recorded, reducing earnings, but no actual cash leaves the company's bank account in that period for that specific depreciation charge. These are the kinds of non-cash elements we're talking about. They're crucial for painting an accurate picture of profitability, absolutely, but they're distinct from immediate cash movements. Now, this fascinating divergence between earnings and cash flow and its surprising predictive power for stock returns, it first gained widespread attention with the groundbreaking work of Sloan back in 1996. He meticulously documented that firms characterized by high accruals, so those with a larger proportion of their earnings tied up in these non-cash items, consistently generated abnormally lower future stock returns. And conversely, companies exhibiting low accruals reliably produced higher future returns. This wasn't just a fluke or a one-off event, it was a predictable recurring pattern across different industries and time periods.
Yeah, to give you a vivid mental picture, let's consider two hypothetical companies. Let's call them Innovate Tech and Steady Flow. And let's say they both report the exact same net earnings for the year. Okay, but their underlying financials tell very different stories. Innovatech has high accruals. This could mean they've just launched a massive expansion, maybe generating significant sales on credit, leading to a surge in accounts receivable.
Or perhaps they're rapidly building up inventory in anticipation of future demand. Their earnings look robust on paper, sure, but a lot of it isn't yet cash in hand. Steady Flow, on the other hand, boasts low accruals. Their business model might be more cash-based, maybe with quick inventory turnover and prompt collection of receivables, so their earnings are more closely aligned with their actual cash flow. What Sloan's research revealed, much to the surprise of many at the time, was that, on average, Steadyflow, the low accrual company, would see its stock perform noticeably better in the future compared to Innovate Tech. And this wasn't just a minor statistical blip, it was a significant effect. It quickly became a cornerstone of capital markets research, sparking, well, countless studies worldwide trying to dissect its origins and implications.
Yes, exactly. And if we step back and connect this to the broader landscape of financial theory, for many years, almost every explanation for this perplexing accrual anomaly gravitated towards some form of investor irrationality or maybe naivete. The central tenet of this traditional view was that investors systematically overestimated the persistence of the accrual component of earnings. They simply didn't fully grasp, or perhaps didn't fully price in, the idea that these non-cash earnings might not translate into sustained, robust future profitability or, crucially, strong cash generation. You can imagine investors seeing a company's reported earnings jump because of a large accrual, and then mistakenly extrapolating that high level of reported earnings way out into the future without adequately discounting the non-cash nature of those earnings. But as a direct consequence of this perceived cognitive bias, investors were, well, systematically surprised. When high accrual firms' reported earnings inevitably fell short of those perhaps overly optimistic expectations, or when low accrual firms' earnings exceeded the more conservative forecasts, it led to what was interpreted as systematic mispricing in the market. The thinking was that the market would slowly, eventually, correct these initial mistakes over time, and that correction process led to the predictable pattern of returns. This established a very strong behavioral economics flavor to the explanation of the accrual anomaly. It painted a picture of a market where investor psychology played a pretty significant role in creating these seemingly predictable patterns. It was a powerful and, for a long time, widely accepted narrative, deeply embedded in the academic literature.
So that's the long-standing narrative, investor mistakes, basically. But this is where the paper we're discussing today introduces a genuinely groundbreaking alternative, one that fundamentally shifts our perspective. Instead of positing investor irrationality, it proposes an optimal investment hypothesis, an explanation that is entirely consistent with rational economic behavior. The core, really revolutionary idea here is that accruals are not merely accounting quirks or some kind of fuzzy signals of earnings quality that investors might misinterpret. Instead, they are, in fact, a direct form of investment, and specifically, they represent a company's strategic working capital investment. Companies, in this view, are actively and rationally choosing to make these investments based on fundamental economic conditions. And this hypothesis is deeply rooted in the Q theory of investment. That's a cornerstone of economic thought developed by pioneers like James Tobin back in '69, and later formalized by researchers like Hayashi in '82 and Cochrane in '91. At its essence, Q theory posits a very rational decision-making process for firms. Companies will choose to invest in new projects or expand their operations when the expected marginal return on that investment is higher than their cost of capital, which is essentially the discount rate that investors apply to their future cash flows. It's a precise, rational economic calculation. So if we start viewing accruals as a form of investment, then this entire anomaly might just be a natural outcome of rational corporate decision-making and efficient market pricing, rather than some kind of systematic investor error.
Indeed. And a truly powerful insight from this research, from this paper, is that the Q theory of investment makes a very specific and crucially testable prediction. It forecasts a robust inverse relationship between a firm's investment decisions, which, as you said, we're now understanding to include accruals, and its discount rate. And this discount rate, of course, is what fundamentally reflects its expected future returns. Let's really break this down into clear scenarios, because this is the theoretical engine driving the whole new explanation. Okay, consider our first scenario. Imagine that, for whatever reason, the market's discount rate for a particular firm, which we could think of as its cost of capital or the expected return investors are demanding, imagine it falls. Maybe overall market risk is decreased, or the company's specific risk profile has improved somehow. When this happens, suddenly a wider array of potential investment projects within that company, projects that might have seemed marginal before, now become profitable, because the hurdle rate, the required return is lower. As a perfectly rational response, firms will optimally increase their investment in these newly attractive projects.
And crucially, this increase in investment naturally leads to higher accruals. Why? Because working capital components like inventory, raw materials, or accounts receivable all tend to rise as a company scales up its operations and investment activity. But here's the pivotal connection, the real linchpin. Because the underlying discount rate was lower in the first place, it inherently means that the firm's future expected returns going forward are also lower. Investors are now satisfied with a lower return for holding that stock, given its lower risk or cost of capital. So the ultimate result is clear. High accruals, which are driven by this rational increase in investment, end up predicting lower future returns. It's not a market mistake. It's a completely rational and self-consistent economic outcome predicted by the theory. Okay, now let's flip that coin. Let's consider scenario 2. What if the market's discount rate rises? Maybe there's an increase in systemic risk, or the company's specific outlook darkens, prompting investors to demand a higher rate of return for taking on that risk. In this kind of environment, fewer investment projects will be able to meet that higher profitability hurdle.
Therefore, firms will rationally decrease their overall investment. They'll cut back. And this leads to a corresponding decrease in accruals as they perhaps draw down inventory, reduce receivables, or scale back operations. And of course, because the initial discount rate was higher, it means the future expected returns for that firm are also higher. Investors demand more, thus the result. Low accruals, stemming from this rational reduction in investment, predict higher future returns. So pulling these threads together, what this all means is that the negative relationship we've consistently observed between accruals and future returns isn't necessarily about investors mispricing assets because they're somehow confused by accounting numbers or, fall victim to behavioral biases. Instead, this offers a powerful and I think quite intuitive explanation. It's about firms rationally adjusting their investments, and thus their accruals, in direct response to changing discount rates. And those discount rates are, by their very nature, inherently linked to their future expected returns.
It's an intuitive economics-based framework, as the paper calls it, that completely turns the traditional investor irrationality interpretation on its head. To truly appreciate the robustness of this elegant idea, though, we need to delve a bit deeper into the theoretical underpinnings that formally establish this fundamental link.
That is a powerful and really coherent narrative.
Yeah.
To formalize this intuitive link between investment, accruals, and discount rates, the paper develops a concise two-period Q-theory setup. It builds on foundational work by Li, Livdon, and Zhang from 2008. In this theoretical model, the authors effectively use accruals and working capital investment almost interchangeably. And that's a key conceptual move, right? It allows us to view accruals not just as accounting entries, but as a direct proxy for a company's short-term operational investments. The model posits that firms utilize both long-term fixed capital, things like factories, machinery, physical infrastructure, and short-term working capital, which includes assets like raw materials, inventory, accounts receivable. They use both as complementary inputs in their production processes. Now, a central and very common assumption in this type of economic model is decreasing returns to scale. While the paper uses a specific mathematical representation, which we don't need to get bogged down in right now, the intuition is actually quite straightforward. A company will naturally pursue its most profitable and efficient investment opportunities first. That makes sense. So as it continues to pour more and more capital into projects, each subsequent investment tends to yield a slightly lower return than the one before it. It's just the economic reality that there's always a finite pool of truly stellar opportunities, and eventually, factors like managerial capacity, market saturation, or resource constraints mean that growth and additional investment become incrementally harder and less profitable at the margin. The firm's overarching goal within this framework is simply to maximize its market value by meticulously choosing the optimal levels of both long-term and working capital investments. This involves a fundamental trade-off. Investing today means foregoing current cash flow, yes, but it's done with the rational expectation of generating higher cash flow and profitability tomorrow. The condition for optimality is reached when the marginal cost of making an investment, which, as we discussed, is essentially the market's required discount rate, are precisely equal to the marginal returns derived from both its long-term and working capital investments. It's a delicate balancing act.
Okay, so this brings us to a crucial question for the model. How does working capital investment, which is our proxy for accruals, how does it actually respond to changes in that discount rate, R, within this rigorous framework? Well, the mathematical derivations in the paper, which meticulously trace the relationships, clearly demonstrate a fundamental inverse relationship. Specifically, if the expected discount rate for a firm goes down, then its optimal working capital investment, and consequently its accruals, will reliably go up. It's a direct, predictable cause and effect, not some accounting anomaly. The key takeaway here is both, I think, profoundly simple and powerfully elegant, and really encapsulates the fundamental Q theory insight. The principle is that more investments inherently reduce the marginal returns to investment. Think about it. Once you've capitalized on all the best opportunities, the next ones are naturally less profitable. And if the marginal returns to investment are lower, well, that means the discount rates or expected returns for that firm must also be lower. Why? Because, rationally, firms will continue to invest until the marginal returns on their investments decrease right down to the level of the discount rate. It's a point of equilibrium. This means that if a firm exhibits high accruals because it has actively and optimally invested, its marginal returns on any further investment are now lower, which in turn implies a lower discount rate and therefore lower expected future returns for investors holding its stock. The powerful implication of this first proposition is that things like investor overreaction or even managerial overinvestment are not necessary ingredients to explain this observed negative relationship between accruals and returns. Optimal investment alone, driven by rational economic decisions, directly gives rise to the negative relation between investment and expected returns. It's testament to the power of a purely rational economic driver.
Okay, now, economic literature on investment often introduces an additional layer of realism. It often assumes adjustment costs for long-term capital, and this is a pretty well-established idea, right? It's simply costly and time-consuming to rapidly expand or shrink operations. I mean, imagine the expense and the logistical headache of suddenly building a new multi-billion-dollar factory, or conversely, shutting down a major production line overnight. Researchers like Cochrane back in '91 have long recognized these real-world constraints. What this paper strikingly demonstrates, through further extensions of its model, is that incorporating these adjustment costs doesn't actually undermine the core theory. In fact, it reinforces the negative accruals discount rate relation. It actually makes that inverse link even stronger and more robust.
Exactly. And this leads us to a particularly insightful and honestly somewhat surprising finding in their second proposition. It states that the inverse relationship between working capital investment and the discount rate holds true as long as adjusting that long-term capital is costly. What's truly remarkable, though, is that according to their model, even the assumptions of decreasing marginal returns to investment, which, as we just discussed, seems intuitively sound, and even working capital adjustment costs themselves, which you might also expect, are both unnecessary to establish this negative relationship. That really simplifies the conditions under which the theory holds. So why is this the case? Well, the paper explains it beautifully by emphasizing that long-term capital and working capital are complementary inputs in the production process. Think of them as partners working together, essentially. When a falling discount rate makes it optimal for a firm to increase its long-term capital, say, by deciding to build that new factory or significantly upgrade its machinery, its working capital and thus its accruals will also naturally rise in tandem. They move together, because you can't really have one without the other, operationally speaking. You don't just invest in a new production facility without also investing in the raw materials, the inventory to fill it, and the accounts receivable that naturally arise from selling the products it produces. It's an integrated investment decision. Changes in one input necessitate changes in the other.
Okay, so pulling all these theoretical threads together, what this means is that this investment-based approach offers a significant conceptual distinction from many traditional asset pricing models, like the well-known capital asset pricing model, CAPM. Those traditional models, they often begin their analysis from the perspective of consumer utility and tend to simplify firms as just exogenous cash flow processes, meaning they largely assume cash flows simply appear without deeply modeling how firms internally generate those cash flows or make strategic investment decisions. This new approach, however, takes a fundamentally different path. It's built upon the firm's own value maximization problem. It endogenously links the discount rate, and therefore expected returns, directly to observable firm characteristics like working capital investment, which, as we've established, is a key component of accruals. This allows us to explain how risk and expected returns are intricately connected with tangible, observable accounting variables. And that provides a much richer, more integrated, and ultimately, I think, a more satisfying understanding of market dynamics.
Right.
So, with this robust theoretical framework now firmly established, the logical next step is, well, to see how it holds up against the real world. We're going to pivot now from theory to data, examining how empirical evidence powerfully supports this rational explanation by unpacking the paper's 4 key hypotheses. First up, let's explore Hypothesis 1, the power of the investment factor. The core idea here is deceptively simple but profoundly impactful. If accruals are indeed just a reflection of optimal investment decisions, and if that investment drives the anomaly, then if we can properly account for or control for investment in our analysis, it should significantly diminish or maybe even entirely erase the anomaly's observed effect on future returns. Okay, so to test this, the authors ingeniously construct what they call an investment factor, which they denote as RINV. How does this work? Well, imagine sorting all publicly traded companies based on their investment to assets ratio, essentially, how much they're investing relative to their size. The investment factor is then formed by taking a long position, meaning buying the stocks of companies that have low investment to assets ratios and simultaneously taking a short position, meaning selling the stocks of companies that have high investment to assets ratios. This strategy is basically designed to capture the return premium associated with investment levels, and the empirical data supporting this is compelling. This investment factor itself consistently earns a highly significant average return of 0.57% per month. That comes with a strong statistical significance, a t-statistic of 6. What's more, even after meticulously controlling for standard market risk, company size, and value factors in their regressions, the usual suspects in asset pricing models, this investment factor still maintains a robust, significant alpha. That's the abnormal return above and beyond what those traditional factors would predict. It comes in at 0.62% per month with an even higher t-statistic of 7.1. This strong, independent performance sends a really clear signal. Low investment reliably predicts high future returns.
Exactly. And this is where the real game changer emerges. When this powerful investment factor, RINV, is introduced into those standard asset pricing models like CAPM or the Fama-French three-factor model, to explain the returns of the traditional accrual-based trading strategies. Remember, that's going long on low accrual firms and short on high accrual firms. Well, the results are nothing short of striking. As we see in the paper's Table 5, for strategies based on total accruals, which they call TOTA, the abnormal return, that alpha we just discussed, is reduced by a massive 65.5%. It plummets from an initial, statistically significant 0.75% per month down to a mere 0.26% per month. And critically, it becomes statistically insignificant. Think about that. Nearly 2/3 of the so-called anomaly just vanishes when you account for investment. And the pattern holds for other accrual measures too. For discretionary accruals, DISA, often considered a proxy for earnings management and thus may be prone to investor misinterpretation, the reduction in alpha is also substantial at 60.7%.
And for net operating assets, NOAA, which is a broader measure of non-cash operating assets, the reduction is even more dramatic, a remarkable 82.4%. This robust evidence powerfully supports Hypothesis 1. It implies that the investment factor substantially neutralizes the magnitude of the accrual anomaly, often pushing it down to statistically insignificant levels. This insight fundamentally redefines the puzzle, doesn't it? It suggests that much of what we previously thought was an accrual anomaly driven by investor irrationality might, in fact, simply be an investment anomaly in disguise, just a rational outcome of how firms manage their capital in response to discount rates. And further supporting this, the paper's Table 6 shows the event-time evolution of investment behavior. High accrual firms indeed have much higher investment to assets, IAA ratios. For instance, the highest decile of total accruals had an IA ratio of 26% at the portfolio formation year, whereas the lowest decile had only 9.9%. This clear and consistent investment pattern helps explain the accrual anomaly from a compelling rational perspective. Okay, moving on. The second hypothesis takes us to a more direct test.
Hypothesis 2. Direct glimpses of the discount rate. The core logic here is pretty straightforward. If the accrual anomaly is truly driven by that predicted inverse link between investment, which we're now consistently associating with accruals, and the discount rate, then we should empirically find that high accrual firms also exhibit lower estimated ex-ante discount rates. And conversely, low accrual firms should reveal higher ex-ante discount rates. Ex-ante here just means expected beforehand or forward-looking. The challenge, of course, is that actual realized stock returns are often, imprecise and likely even biased as a direct, perfect measure of the true underlying expected discount rate that investors demand. They're noisy. So the authors cleverly sidestep this limitation by employing alternative, more sophisticated methods to estimate that elusive discount rate directly.
Right. And one of the primary and I think most compelling methods they employ is the dividend discounting model. This is a well-regarded approach pioneered by Fama and French back in 2002. To simplify its essence, this model estimates a company's expected return, which is our proxy for the discount rate, by looking at its expected dividend yield combined with its expected long-term dividend growth rate. It's a forward-looking measure deeply rooted in fundamental economic expectations about a company's ability to generate and distribute value over time. And the results from this model, which are presented in the paper's Table 7, offer exceptionally strong support for Hypothesis 2. Really strong. They found that the lowest quintile of firms sorted by total accruals, so the bottom 20% of companies with the lowest total accruals, had a significantly high estimated discount rate of 8.1% per annum. Now, in stark contrast, the highest quintile of firms, the top 20% with the highest total accruals, had a remarkably low estimated discount rate of just 2.2% per annum. That's an astonishing spread of 5.9% per annum between the two extremes, a difference that is, get this, more than 10 standard errors from zero. That statistic alone just underscores the immense reliability and statistical significance of this finding. It's huge. Similar, robust spreads were observed for discretionary accruals, DISA, showing a 3.8% difference, and for net operating assets, NOAA, with a 5.4% spread. And a truly crucial insight emerging from this analysis is that the lion's share of the spread in discount rates actually stems from differences in the expected long-term dividend growth rate. Essentially, high accrual firms, which remember are the high investment firms, are expected to grow less in the long run after their initial investment push. This leads to lower future cash flows, thus demanding a lower discount rate today. Low accrual firms, conversely, are expected to grow more sustainably. This aligns perfectly with the Q theory's predictions about diminishing marginal returns to investment over time.
Okay, and the second estimation method they utilized was the residual income model. This is a framework developed by Gebhardt, Lee, and Swaminathan in 2001. It's a sophisticated approach that aims to estimate the implied cost of equity by essentially working backward. It takes current stock prices and combines them with analyst consensus earnings forecasts. It basically calculates the discount rate that would rationally justify the current market price, given those future earnings expectations. Now, the results from this model, detailed in Table 8 of the paper, were a bit more nuanced than the dividend discounting model, but still generally supportive, I would say. For total accruals, TODE, low accrual firms indeed exhibited a contemporaneously higher estimated discount rate, 9.76% compared to 9.11% for high accrual firms. This represented a spread of 0.65%, which was statistically significant with a t-statistic of 4.33. So still significant. They found similar statistically significant support for net operating assets, NOAA, showing a 0.54% spread. However, there's a point of nuance here.
The authors noted that the magnitude of the discount rate spread is too small relative to the spread in average ex-post returns that are actually observed in the market. So the size didn't quite match up with the observed returns. Furthermore, for discretionary accruals, DISA, the support from this particular model was somewhat weaker, with the spread being either close to zero or even in a few instances moving in the wrong direction. So while the dividend discounting model provided really clear, strong evidence for Hypothesis 2, the residual income model offered a more mixed but still largely supportive picture, especially for TODA and NOAA. The paper openly acknowledges these differences in magnitudes, but crucially emphasizes that the direction of the relationship lower discount rates for high accrual firms, higher for low accrual firms, is largely consistent with the optimal investment hypothesis, reinforcing the core economic mechanism.
Okay, let's transition now to Hypothesis 3. Accrual reliability more than just quality. To truly appreciate the nuance here, we need a little bit of historical context. Earlier, influential work by Richardson and his colleagues back in 2005 explored this concept of accrual reliability. They demonstrated that less reliable accruals, think of items like rapid changes in non-cash working capital or big movements in non-current operating assets, often correlated with lower earnings persistence and greater potential for mispricing. The prevailing conclusion at the time was that these less reliable accruals were precisely why the accrual anomaly was stronger for certain components. Investors were more likely to misinterpret these lower quality accounting figures. But this new paper offers a powerful reinterpretation. It proposes that, yes, the magnitude of the accrual anomaly is indeed stronger for less reliable accruals, but not primarily because of their intrinsic accounting quality or how hard they are for investors to understand. Instead, the paper argues, it's because these less reliable accruals are, in fact, more directly and strongly correlated with the firm's underlying investment activity than are the more reliable accruals. It's a subtle but really significant shift in causality, isn't it? Moving the focus from investor cognition to fundamental firm economics.
Absolutely. And to rigorously test this,
The paper meticulously breaks down total accruals into three broad categories, following that established framework from Richardson et al. First, we have the change in non-cash working capital, WC, which is generally considered to have medium accounting reliability. Second, there's the change in net non-current operating assets, GATO, typically viewed as having low to medium reliability. These are things like property, plant, and equipment changes. And third, the change in net financial assets, GAVIN, which is characterized by high accounting reliability. Things like changes in cash or debt. Now, when they examine the direct correlation of these specific accrual components with the firm's investment to assets ratio, the findings laid out in Table 9 are incredibly illuminating. GAVIN, the less reliable component, exhibits the highest positive correlation with investment to assets, a robust 0.64. That's a powerful link. GAVIN, with its medium reliability, follows with a correlation of 0.23. Still positive. Intriguingly, GAVIN, the highly reliable component, actually shows a negative correlation of -0.19 with investment. And delving even deeper into an extended decomposition, the paper shows that components like ACOA, changes in current operating assets like accounts receivable and inventories, and ANC-OA, changes in non-current operating assets like PP&E, have very high positive correlations with investment at 0.53 and 0.71 respectively. This makes sense because these components directly represent a company's short-term and long-term capital investments. So what does this all mean? Well, for the most part, less reliable accruals are demonstrably more correlated with investment than more reliable accruals. This pattern aligns perfectly with the optimal investment hypothesis, suggesting that the perceived reliability might just be a secondary characteristic to the underlying fundamental link to a firm's investment decisions.
Right. And when we examine the predictive power of these decomposed accruals through the lens of that investment factor, the story becomes even clearer. Sorting firms based on NCO and WC both produce strong low minus high returns, specifically 8.4% and 7.7% per annum, respectively. That's quite high. Interestingly, sorting on DUFIN, the highly reliable component, actually produces a negative average return of -6%. This precise pattern, where the stronger the link to investment, the stronger the anomaly, and vice versa, perfectly matches their observed correlations. It fits like a glove. Then, when that all-important investment factor, RANV, is introduced into the factor regressions, as detailed in Table 10, it significantly reduces the alphas for NCO by a substantial 51% and for DODC by a remarkable 60%. This further strengthens the argument that much of the anomaly's effect, even when considering accrual reliability, is truly explained by the underlying investment decisions of firms.
Yeah, and the paper even brings up an intriguing and very pointed finding here. Some variables, such as changes in financial liabilities, P&L, or long-term debt, were previously categorized as high reliability by the Richardson et al. Study. Okay. However, this paper's analysis reveals they are also highly correlated with investment. Now, here's the critical distinction. The optimal investment hypothesis predicts that these variables should forecast future returns, precisely because of their strong link to investment. In stark contrast, the traditional accounting reliability hypothesis, which emphasizes quality, would predict they should not forecast returns since they are deemed highly reliable. The empirical evidence, however, shows unambiguously that they do predict returns, and crucially, the investment factor significantly reduces their predictive power. This particular piece of evidence is very telling, I think. It lends strong support to the optimal investment hypothesis by elegantly disentangling the two competing explanations, investment versus pure accounting reliability, and showing which one holds up better to the data.
That's a great point. And the analysis of discount rate estimates for these decomposed accruals presented in Tables 11 and 12 further bolsters this argument. Using the robust dividend discounting model, Table 11, less reliable accruals like NCO and WC consistently show significant discount rate spreads of 3.5% and 4.6% per annum, respectively. This is entirely consistent with our optimal investment hypothesis. The more reliable NMR, on the other hand, exhibits a much smaller spread of only 0.9%. The residual income model, Table 12, also largely echoes this pattern, showing significant spreads for NCO, 1.14%, and NWC, 0.32%, while UTM once again registers a negligible spread. So while some specific results for the extended decomposition might be a bit mixed across the two different discount rate models, the overall pattern strongly supports the central idea that less reliable accruals cover more directly and intensely with ex-ante-discount rates than more reliable accruals. This further reaffirms that powerful and consistent link between accruals, investment, and expected returns.
Okay, let's turn our attention now to the fourth and final hypothesis, Hypothesis 4. The anomaly's shifting sands time-varying returns. There's been a persistent observation in the literature that ever since Sloan's initial discovery back in '96, the accrual anomaly seems to have deteriorated over the years. It seems weaker now.
Studies by Green, Hand, and Solomon in 2009, for instance, visually documented a noticeable decrease in the average returns of accrual trading strategies, with the particular weakening evident after about 1998. This raises a crucial and really fascinating question. Is this perceived deterioration simply because sophisticated arbitrageurs have learned about the anomaly and systematically arbitraged it away, the so-called learning hypothesis? Or is it due to predictable underlying time variation in the expected returns of these strategies, meaning the anomaly's strength waxes and wanes with the economic conditions? This paper champions a time-varying risk hypothesis. It proposes that the expected returns to accruals-based strategies are fundamentally countercyclical. Now, what does countercyclical mean in this context?
It means these returns are typically higher in bad economic times, when overall market risk is elevated, and lower in good economic times, when investors demand less compensation for risk. This idea connects beautifully to Zhang's 2005 foundational work on the value premium, which observes similar countercyclical patterns. In this framework, firms with high accruals are often likened to growth firms. They're investing heavily, foregoing current cash for future expansion, perhaps perceived as less risky in good times. Low accrual firms, conversely, are more akin to value firms. They have strong current cash flows and less aggressive investment profiles. The theory suggests that firms with lower accruals, like value firms, might be more susceptible to economic downturns, and thus should offer higher expected returns during those riskier, more uncertain periods, providing compensation for bearing that economic risk.
Right. And to put this to the test, the authors conducted predictive regressions. They used variables well known for forecasting broader market returns to see if they could also predict the returns of these accruals-based strategies. Panel A of Table 13 focuses on the variance risk premium, or VRP. This is a sophisticated measure representing the difference between the implied volatility of the S&P 500, derived from options prices, and its actual realized variance. VRP is already known as a strong predictor of market excess returns, but and this is more important for our discussion today, it also powerfully predicts returns to accruals-based strategies. Specifically, looking at the quarterly horizon, a higher VRP indicating higher market uncertainty and risk predicts significantly higher returns for low minus high total accruals, TOTA, discretionary accruals, DISA, and net operating assets, NOAA strategies. The adjusted R-squared values for these regressions are quite impressive, 3.47%, 2.37%, and a remarkable 8.79% respectively. That means VRP explains a decent chunk of the variation. Moreover, the slopes of these regressions are universally positive and mostly significant across various horizons. This robust finding clearly indicates that periods of high VRP, signaling greater market uncertainty and risk, reliably predict higher returns for accrual strategies. This is perfectly consistent with these strategies being countercyclical, offering investors greater compensation when economic conditions are more volatile and risky.
Exactly. And they further bolster their case by examining traditional macroeconomic conditioning variables, as detailed in the other panels of Table 13. Panel B looks at the term premium, which is the difference in yield between long-term and short-term government bonds. This variable generally predicts market excess returns positively, particularly at longer horizons. Consistently, it also forecasts higher returns for low minus high DISA strategies over longer periods, again hinting at that countercyclicality. Panel C considers the relative Treasury bill rate. A high Treasury bill rate often signals good economic times, which typically translates into lower future market returns. In line with this, the relative bill rate predicts low minus high DISA returns negatively, further supporting the idea that these strategies perform better when economic conditions are less favorable. However, Panel D, which focuses on the default premium, that's the spread between BA and corporate bonds, introduces a fascinating nuance, a slight wrinkle. The default premium itself is typically countercyclical, meaning it widens in bad economic times, and it usually predicts market excess returns positively. A high default premium signals distress, and consequently higher future market returns are expected. Intriguingly, though, it forecasts lower returns to accruals-based strategies. It displays negative slopes. This is a point of divergence. As the paper notes, while the evidence from predictive regression so far is largely consistent with the time-varying risk hypothesis, Panel D documents some evidence that is not. This just highlights that even within a powerful framework, some complexities remain, and not every single variable aligns perfectly with every aspect of the hypothesis.
Right. On balance, though, and despite that specific nuance with the default premium, the overwhelming body of evidence presented suggests that the expected returns to accruals-based trading strategies are, in fact, time-varying, and behave in a countercyclical manner. And this is a genuinely significant conclusion, isn't it? Because it implies that the recent deterioration of the accrual effect, that perceived weakening of the anomaly over the past few decades, might actually be temporary and likely to mean revert in the near future. It's not necessarily that the anomaly has been entirely arbitraged away forever, but rather that its strength fluctuates with the broader economic cycles. It offers opportunities during riskier periods and maybe subsides during calmer ones.
Absolutely. And it's important to acknowledge, as the authors do, that distinguishing definitively between this time-varying risk explanation and the learning hypothesis, which would imply a monotonical decrease in the anomaly as investors become increasingly informed, is notoriously difficult in empirical finance. It's hard to prove one way or the other definitively. However, the paper puts forward a very compelling counterargument against the pure learning story. They say, it is hard to imagine investors forgetting in bad times what they've learned previously. I mean, if it were simply about investors learning and correcting a mispricing, the effect should disappear and stay gone, right? The observed cyclical nature, where the anomaly seems to strengthen and weaken, points much more strongly towards a fundamental, rational, time-varying risk premium at play, rather than just a simple one-way process of market participants getting smarter over time.
Okay, so this new, powerful, rational perspective isn't merely about offering an alternative explanation for the accrual anomaly itself. It actually possesses a much broader utility. It allows us to reinterpret other long-standing observations in finance that were previously cited as, well, almost irrefutable evidence for investor irrationality or behavioral biases. It's like revisiting old evidence with a completely new pair of glasses, isn't it? And seeing a fundamentally different picture emerge. Let's explore how this optimal investment hypothesis can elegantly accommodate some of these seemingly perplexing findings.
Right. First, let's consider earnings announcement returns. Sloan's original 1996 work, the one that first identified the anomaly, showed that the predictable returns generated by accrual strategies were heavily concentrated around earnings announcements. The traditional interpretation here was always that investors were being systematically surprised when companies released their earnings, implying they hadn't fully incorporated the information contained in accruals beforehand. But investment-based asset pricing offers a completely different rational perspective. It actually predicts this concentration of returns around earnings announcements. Why? Because the stock return is equal to the investment return in this framework. Therefore, it's actually quite natural for the expected return to be realized around earnings announcements when earnings news is released to the markets. Earnings announcements are periods of significant information flow, right? They convey more new information about a firm's performance and future prospects, and inherently raise risk as uncertainty is resolved. Investors, in a rational market, expect compensation for bearing this heightened risk, and that compensation naturally materializes when the relevant information comes to light. It's not necessarily a surprise, it could just be the efficient realization of expected returns during these information-rich periods.
Okay, that makes sense. Next, let's turn to analyst forecast errors, which has always been a classic piece of behavioral evidence. Bradshaw, Richardson, and Sloan, in their 2001 study, found that sell-side analysts often fail to adequately incorporate future earnings declines for high accrual firms into their forecasts. This was widely seen as strong evidence that analysts, and by extension the broader market, were ignoring crucial information about earnings quality, leading to persistent mispricing. However, the optimal investment view doesn't necessarily refute the existence of these forecast errors, but rather offers a rational, maybe incentive-based explanation for why they occur, without needing to assume analyst irrationality. Why? Well, analysts are not perfectly unbiased robots, are they? They face significant conflicts of interest problems. They often work for securities firms, and their compensation can be directly linked to short-term performance, generating trading volume, or maybe securing investment banking business. These incentives can encourage them to be optimistically biased in their forecasts. The paper suggests this optimistic bias is likely larger for firms with high accruals, precisely because these firms invest more, need more external financing, and are more actively traded, unquote. All of these factors provide analysts with stronger financial incentives to issue optimistic forecasts, perhaps to please management or generate business, rather than accurately reflecting the long-term implications of accruals. It could be a rational response to their own incentive structures, not necessarily a cognitive failing.
Good point. Moving to auditor opinions, another area where traditional views highlighted behavioral elements. Bradshaw, Richardson, and Sloan also showed in 2001 that high accrual firms were statistically less likely to receive unclean audit opinions from their auditors. The implication drawn was that auditors weren't flagging potential issues related to future earnings declines or maybe aggressive accounting practices associated with high accruals, again suggesting a market failure of sorts. However, the optimal investment hypothesis offers a coherent, rational counter-narrative here as well. If, as our theory suggests, accruals are negatively correlated with risk, meaning high accrual firms, due to their investment patterns are generally lower risk, and low accrual firms are commensurately higher risk, then high accrual firms should naturally be less likely to have modified auditor opinions. It just reflects their lower risk profile. Conversely, riskier low accrual firms would be more likely to trigger auditor scrutiny. This interpretation is entirely consistent with firms reporting accruals faithfully, simply reflecting their economic realities. Furthermore, similar to analysts, auditors also face potential conflicts of interest problems, as starkly illustrated by historical examples like the Enron Arthur Andersen scandal, where a desire to maintain lucrative consulting fees could potentially compromise independence. So the lack of unclean opinions for high accrual firms could be a rational outcome of their lower risk profile, or maybe even an incentive-driven decision by auditors, rather than a symptom of systemic accounting misinterpretation.
And what about the corporate bond market? This was always a puzzling one. Podroj and Swaminathan in 2009 presented evidence that corporate bonds issued by high accrual firms seem to underperform those of low accrual firms. This was particularly perplexing to the traditional view because bond investors are generally considered highly sophisticated, right? They're laser focused on cash flows and presumably less susceptible to the kind of accounting misinterpretation attributed to equity investors. The traditional view really struggled to explain why even these savvy bond investors would be confused by differences in earnings quality. However, the optimal investment view provides a much more elegant and rational explanation. Why? Because, as Robert Merton famously noted way back in 1974, bond and equity are different contingent claims written on the same productive assets and should therefore share similar sources of risk. What applies to equity in terms of risk and expected return should also, to some degree, apply to bonds issued by the same firm. Therefore, the optimal investment hypothesis also predicts discount rate variation across corporate bonds issued by firms with extreme accruals, mirroring what we see in equities. This explanation does not assume systematic cognitive failures on the part of sophisticated institutional bond investors, but rather a consistent, rational response to underlying economic risk that impacts all financial claims on a firm's assets.
Right. And finally, let's consider short sellers, another group often seen as critical arbiters of market efficiency. Richardson's 2003 study found no evidence that short sellers actively trade on the basis of information contained in accruals. This led many to conclude that the market wasn't fully impounding crucial information about earnings quality, and that short sellers, despite their sophistication, weren't exploiting this alleged mispricing. But this observation also aligns perfectly with, and certainly does not refute, the optimal investment hypothesis. Why not? Well, if, as our theory suggests, the average returns of accrual portfolios are simply compensation for risk rather than a mispricing anomaly, then rational short sellers should have no inherent incentives to short high accrual stocks. Why would they? These stocks aren't necessarily mispriced in this rational framework. They are simply priced to reflect their fundamental economic risk and expected returns. Additionally, there are practical barriers to consider. High accrual stocks tend to be smaller and less liquid, meaning they can be harder and more costly to short, further dampening any incentive even if a slight mispricing were perceived.
So the lack of short-selling activity around accruals becomes a potentially rational outcome, driven by either the absence of true mispricing or simply the high costs associated with trying to exploit it.
So, as we bring this deep dive to a close, what's the fundamental takeaway from this journey into the accrual anomaly? We've navigated a phenomenon that has, well, perplexed financial experts for decades, and we've explored a truly fresh, genuinely groundbreaking perspective. By reinterpreting accruals not as mere accounting quirks or signals of potential mispricing, but as a direct manifestation of working capital investment, this paper offers a powerful, rational explanation, one rooted firmly in the venerable Q theory of investment. It fundamentally flips the script, doesn't it? The accrual anomaly, in this view, isn't about irrational investors consistently making cognitive mistakes. Instead, it's about firms optimally adjusting their investments in response to changing discount rates, which are themselves inherently reflections of future expected returns. Let's quickly reiterate those four powerful empirical findings that so robustly bolster this rational view. First, the introduction of a carefully constructed investment factor dramatically neutralizes the anomaly, often reducing its statistical significance to negligible levels. Second, accruals consistently cover negatively with independently estimated discount rates, exactly as the Q theory predicts. Third, The long-observed link between accrual reliability and the anomaly's strength isn't primarily about accounting quality, but is far better explained by how closely those accrual components correlate with underlying investment activity. And fourth, the anomaly's returns are demonstrably time-varying and countercyclical. This suggests that its perceived weakening in recent years may not be its permanent demise, but rather a temporary fluctuation, likely to mean revert in the future. Moreover, this elegant, rational framework offers a consistent economic lens through which we can reinterpret seemingly behavioral evidence from other market participants, showing how a deeper understanding of firm economics can offer compelling alternative explanations.
That's a great summary. And this brings us to a compelling question for you, our informed listener, to maybe ponder as you reflect on this deep dive. Given this new, powerful, rational perspective on the accrual anomaly, where what once looked like investor irrationality is reframed as optimal firm behavior, how might we begin to rethink other market anomalies that are currently attributed to or heavily influenced by irrational investor psychology? Are there other instances where a more profound understanding of firms' optimal economic decisions, their rational responses to market conditions, their cost of capital, their strategic investments, could provide a more elegant, comprehensive, and ultimately rational explanation for seemingly baffling market patterns? What other long-standing puzzles in finance might simply be part of a bigger, more rational picture, just waiting for us to connect the dots through a deeper economic lens?
We truly hope this deep dive has offered you a powerful shortcut to being well-informed on this fascinating topic, and perhaps even sparked some new questions and avenues for your own exploration. Keep digging, keep questioning, and keep exploring. We'll see you next time on The Deep Dive.